In Market Movers today, the guys are tackling trades connected to the GDP.
Welcome to Market Movers. I'm Jim Iuorio with Scott Martin.
Hi, Jim.
Okay, so the yield curve has inverted, let's call it, in some places, in
yes,
most places.
depending on where you look, correct.
More and more people keep talking about a recession. I think the stock market actually reacted to the yield curve a couple days ago. Is it happening? Are we really going into recession?
I don't believe so. Now, the inverted yield curve has predicted what? I guess 10 of the last 5 recessions. So that's a possibility. But I would say so far, Jim, other than some equity volatility, it doesn't appear like recessionary fears are showing up in the stocks yet.
We have a print on GDP on Thursday. Is it going to be watched more now that this recession word is everywhere?
Yes, I think everything related to, say, big data when it comes to the economy, whether it is jobs or certainly GDP, as you mentioned, is worth pointing out because of the fact that it has so much implication on maybe what future growth looks like.
Now, before we dive into our trade discussion, I'd like to point out that these are examples, not trade recommendations or advice. When we price these out, the E-mini's trading about 28.12. Scott?
Yeah, so depending on what time you look at it, Jim, there's starting to be that feel, though, that volatility is coming back in, doesn't it? So maybe there's some expression as far as the options market, my friend, where there's maybe some things to take advantage of, given the fact that we've started to see ES bounce around a little bit today. So, Jim, especially I'm looking at buying, in this case, the week 1 April, 28.60, 28.80 call spread for about 4 ticks. Now, that's not too bad, right? But I found a way to help myself pay for this in the sense of selling a 2,700 put on the ES for 4 ticks for the expiration of April 5th for both trades. And so risk being long a future at 2,700, yes, if I get that put to me, but also having the max reward of that call spread filling out for about $1,000 in profit. Because of the fact that I like that 2,700 level as an area where I do believe if we do get a pullback in ES, the market will effectively stop there. So I don't believe I'll get put to, but I also like the call spread expression because of the fact I'm bullish on the markets.
I like this trade, and I make trades like this fairly often. People think, oh my gosh, you're selling a naked option. It's risky. Yes, it is risky, but as long as you understand exactly what your risks are, you'd be long at 2,700, which is 113 ticks below where the market is right now. It's a long way away, and we trade
we're still
futures.
Getting something for it, too. 4 ticks to get something for that is relatively nice.
So we understand risk. So as long as you understand the risk, I have no problem with that at all. I'm looking at in a similar expression, but it's different in a couple little nuanced ways. Looking at buying the April 1st, week 1, the 28.40, 28.60 call spread for 7.5 ticks. Now, you pay more for this, but that lower strike is closer. Right, exactly. So it expires April 5th. It risks 375 to make a potential 625. Again, the underlying things are on 28.12, 28.13, right in there. You like it?
I like it. And I like the fact that
it's like it when it agrees with you all the time.
Well, it's the right direction, finally, Jim. It's also closer than mine, too. So that's also an interesting way to express it because of the fact that, like you mentioned, there's in theory, a better probability of it filling up. I do like mine a little better, though, because of the fact I found a way to pay for mine, my friends, because of that put that I was selling.
So yours is a greater risk reward. Mm-hmm. It's also, we said a greater risk if you're long at 2,700. Mine, you pay away the 375, and that's the maximum you can risk as long as you manage it properly. So mine's the sleep easy trade. Yours is the trade that could make more money.
Right, that is a little finagling to it. And the fact, too, Jim, that you mentioned, I mean, this is GDP that's coming out here before basically these expire, and the fact that we could get maybe a stinky number, the market could react negatively. You've already seen that pressure on rates. That's one of those areas where volatility is likely to kick in here, and therefore option premium may get more expensive.
Thanks for joining us on Market Movers. I'm Jim Iuorio, where we are helping to make you a better trader.
Check out businessfirstam.com to find out where to see our entire show. And don't forget to like, follow, and share Business First AM.